Hello and welcome to the lecture for Chapter 8. This chapter, as you can see, deals with long-term assets, so assets that benefit an organization from year to year to year. So we'll talk about kind of how those are defined and kind of what the uh, organization is of different kinds of assets like that. We'll talk about entries that we would make to acquire and maintain those assets. We'll talk about depreciation, which is a method of cost allocation, not a method of determining value. We'll talk about how to deal with asset impairment, and then finally how to dispose of property, plant, and equipment. I do have one bit of information that I'll pass along to you in that section 8.5 that goes beyond what our book does about trading in assets, which is a really frequent transaction for many businesses. Also talk a little bit about intangible assets and natural resources, and then finally fixed asset turnover ratio. So for many large businesses and even small businesses, fixed assets can be the most significant asset on their balance sheet, or the most significant category of assets. You can see that that's the case here. This company's got $65 million, or $65 billion, I should say, in fixed assets, where current assets are only $16 billion. So it can be a big chunk of a company's balance sheet. And it also is subject to estimations, as we'll talk about shortly. When we allocate cost over the useful life of an asset, we're making estimations about how long the asset's going to last, about what it's worth when we're done with it, all of those kinds of things. So it's important to get a good understanding of how we account for these kinds of acquisitions, and how we account for spreading those costs over time, and how we account for having the asset leave the business in some form. So in terms of a general overview of looking at all of the assets of an organization, we split them into two groups, essentially, and then into further groups within that. The two groups are current assets. Those are assets, again, as I mentioned in a previous lecture, that will be used up or turned into cash within the upcoming moving 12-month window. That's a current asset. Everything else is a long-term asset. It's going to benefit multiple periods. Long-term assets can be divided between tangible assets that we can touch and see, and intangible assets that are of great value to an organization, but we can't see them. So examples of tangible fixed assets, which we'll talk about first, one would be property, plant, and equipment. So property, that's pretty clear. That's land and buildings and things like that. Plant is kind of an old-fashioned word for factory. So all of the things that happen or that exist in our factory, machinery and forklifts and warehouse racking and all of those kinds of things go into plant. And then equipment would include computer equipment, again, possibly machinery, other kinds of physical equipment, vehicles, all of that that a business might own. And then, of course, we have land on the end. The reason land is separated is because it is not depreciated. Land doesn't wear out like other assets do, so we separate land. And then we've got that other category, natural resources, which is applicable for any company that's engaged in either logging or mining or drilling for oil or those kinds of things where a natural resource is secured and is part of the business. Intangible assets fall into two categories. One is those intangible assets that have an identifiable life. So there is a legal life, for example, to a patent. We'll talk about this later as well. And then there are some intangible assets that don't have a defined useful life. They could last forever, like the Coca-Cola trademark as an example. So we'll talk about that near the end of this lecture. So fixed assets, as I mentioned, are long-term or relatively permanent assets, equipment, machinery, buildings, and so forth. So they exist physically, they're tangible, and this is important, they're owned and used by the company in its normal operations. So that means that it's part of what the company uses in order to generate revenue. They're making deliveries with a truck, they're producing widgets with a widget machine, or whatever the case is. What this means is if the company has assets that are not used in its normal operations, maybe they have a building that's not being used that they want to continue to own for future use, but it's not part of their current operations, that then is an investment and it's not depreciated because it's not part of what we're using to generate revenue. If I have a backup machine that I can put in place in case my primary machine goes down, that backup machine that is maybe behind the building with a tarp over it, that's an investment. We don't depreciate it because it's not being used. The other thing is that the assets are not offered for sale as part of its normal operations. So as an example, a flatbed truck for a business that's making picnic tables, that flatbed truck that they use to pick up supplies and make deliveries, that's a depreciable asset, right? That's a fixed asset. If that same flatbed truck is at a Chevy dealership and they're selling flatbed trucks, that's inventory. So the same asset could be treated differently in different businesses. So I want to talk a little bit about the whole how we determine if something should be capitalized or not. So the first step is it going to last a long time? If it's not going to last a long time, if it's something that's going to get used up within a short period of time, we'll just immediately expense it. If it's going to last a long time, then we ask the second question, is it used in normal operations? If it's not being used in normal operations, like the backup machine I talked about, that would be an investment. If it is used in the operations of the company, it would be a fixed asset. A lot of companies also have a financial cutoff. They'll say anything below a certain dollar amount. In my old company, I had $500 as the amount. Below $500, even if it was a long-lived asset like a hammer or something like that, I would expense it just because it's not meaningful to set up something of such low value and spread its cost over its life. It's just the return isn't worth the cost of doing it. Other companies have higher cutoffs. So as an example, at St. Martin's University, the cutoff is $2,500. If it's under $2,500, they expense it. If it's over $2,500, they depreciate it if it's used in normal operations. So this is important. The cost of a fixed asset are all of the costs that it takes to get the asset to the business and ready for use in its operations. So oftentimes that could be more than just the actual initial cost of purchasing the asset. There might be transportation charges required to get the asset from wherever it is to the company. There could be taxes involved that need to be paid. There could be, if it was a used piece of machinery, there could be some refurbishments or repairs that have to be made before it could be used. There might be modifications or customizations that are required to the machine to have it properly function for that company's business. And there might be testing. You might need to do some short test production runs where material is consumed and labor is consumed. All of those costs are going to be part of the initial cost of the machine that we'll use for the value on our balance sheet and that we'll use for our depreciation calculations. So next I'd like to talk about costs that are incurred after we purchase the asset. So they fall into two different categories. One is they only benefit the current period, or they're not going to make the asset last longer than we originally intended it would be, or they're going to benefit future periods. So a good way to think about this is to think about a delivery truck. So an example of a cost that only benefits the current period is changing the oil and doing a tune-up. That's a regularly required kind of maintenance that's going to be done every year as we're using the truck. It doesn't make the truck last longer than the life that we originally anticipated. So with those kinds of expenses, we're just going to debit repair and maintenance expense. We're going to expense those kinds of outlays. On the other hand, if it benefits future periods, then we're going to account for it differently. Those kinds of costs, which are called capital expenditures, could further be divided into two categories. One is an improvement of the asset. That adds service value. So in that case, with our delivery truck again, it may be that we add a plow attachment to the front of the truck that we can take on and off. And when we're not busy in the wintertime, we can plow parking lots for extra revenue, something like that. So it adds some kind of functionality to the asset. If that's the case, we're going to increase the value of that asset and then recalculate the depreciation going forward. Another type would be an extraordinary kind of repair. Again, with our delivery truck example, it would be rebuilding the engine and the transmission. Okay, that's a significant expense, a significant outlay, and it's going to lengthen the life of the asset. Maybe I originally thought this truck was going to last 5 years, and 3 years in, I spend a sum of money to rebuild the engine. Now, instead of lasting 2 more years, it's going to last another 5 years. So in that case, we're going to not debit the asset itself. We're going to debit accumulated depreciation. So we're going to reduce accumulated depreciation. Again, it has a normal credit balance, so debiting it will reduce it. And now we'll have more room to keep depreciating it longer. So I'll show you some examples of journal entries. So the first there is, as we mentioned, it only benefits the current period, debit repair and maintenance expense, credit cash. Now, if we have a capital expenditure where we improve the functionality, the snowplow example I used, we'll debit the asset and credit cash, and again, recalculate depreciation. Lastly, a capital expenditure that extends the useful life will debit accumulated depreciation and credit cash, and again, recalculate depreciation going forward. So depreciation is, again, a mechanism for allocating the cost of reduced functionality of an asset over its life. So assets are either going to wear out physically. So I think we can all relate to that with a vehicle that has a lot of miles on it is not as good as a vehicle that's brand new, right? It wears out over time physically. And there's also functional depreciation. Imagine if you had a bunch of computers that were 15 or 20 years old, they probably wouldn't function for the company like a new computer would, right? They kind of lose their value, even though they're not worn out and they still physically work. They lose their value from a functionality perspective. So one of those two things is going to happen with most physical assets. And that decline in value is what we're spreading over the life of the asset. And it's really a key part of the matching principle, which, if you remember from an earlier lecture, is matching the expenses incurred by a business with the revenues that they're intended to produce. Think about that delivery truck. If we were going to use it for 5 years making deliveries, which we have to do for our business to earn revenue, it would be a mistake to expense that in its first year entirely. That would distort first year results and make the other years look better. And by the same token, it would distort things to record the expense the year the truck dies. In the 5th year, it would distort that. So we want to allocate that expense over the periods in which we're getting the benefit from the asset. So depreciation is based on 3 factors, two of which are estimates. So first we have the initial cost. So we do the work, what are all of the costs incurred to get this asset here and working for us? Then we have to estimate how long are we going to use this asset. So not how long is the asset physically going to exist, but how long is our company going to use it? And then third, we'll look at what is the residual value. People also call that scrap value or that sort of thing. So we'll look at that, and because the difference between what we initially paid for it, the initial cost, and what we can get for it when we're done, is the amount of cost that's being consumed, or the depreciable cost. So different methods for depreciation. The most popular by far, over 90% of companies use straight line depreciation, where we just allocate that depreciable cost, the cost minus the residual value, over the useful life and take an even chunk every year. Now, of course, we'll prorate that if it's purchased during the year. Say we buy an asset on July 1st, we'll have a half of year's depreciation and then a full year the next year and so forth. But that's a very simple method. Most companies use this because, one, it's straightforward to do, but second, it's difficult to determine if we're going to get the benefit from that asset in any way that is other than a smooth over the period of its life. So we could look at it either by dividing by the number of years or take the corresponding percentage. So a 5-year asset that we allocate over 5 years would be 20% per year. 8 years would be 12.5% per year. Think of 1/5, 1/8, 1/10, so forth. So another method is the units of output. And I like this method the best because it really does the best job of matching the expense associated with wearing the asset out with the benefit we're getting. So instead of the denominator being a period of time, like a number of years, in this case it's going to be the units of output we expect from that asset. So for a delivery truck, it could be miles driven. It could, for a forklift, it's hours driven. It could be parts produced by a machine or whatever the case is. So we make an estimate that we're going to use this. I'm going to drive this truck until it has 300,000 miles on it. Then I'm going to trade it in on a new truck, as an example. The benefit with this is, say you've got the delivery truck example, if I have a year, for whatever reason, we don't make very many deliveries, well, we wouldn't recognize very much depreciation expense associated with that. So it's a really good, and then another year, if we use it a lot, we'll recognize more depreciation expense. So it really does the best job of matching. The last method is the double declining balance method, and it's a way of front-end loading depreciation expense, recognizing more of it up front, less of it later in its life. This is a good method if there are assets that we think we're going to use a lot in the beginning and then less so as time goes by. So we take the straight line percentage that I referenced a couple slides ago, and we double it. So if it is a 5-year asset and that's 20% per year, we double that to 40% per year. And we calculate the depreciation expense by multiplying that percentage by the value of the asset, not the depreciable value, not the book value, but the total value. And we do that each period. So the way that looks is I have a $24,000 asset here. And again, I'm not subtracting salvage value to get depreciable. I'm looking at the initial full cost of the assets. 24,000 times 40%, we take 9,600 of depreciation that first year, much more than if we had been doing it straight line. Then at the end of the year, after I make that entry, I look at what the book value is. In this case, 14,400. That becomes the value that I use next year to multiply by 40%. So it reduces depreciation the next year. I do that same math each period, and then the last year I have to plug the depreciation so that the book value doesn't go below the salvage value. So that's where salvage value comes into play in these calculations, is in the last year. So a little bit about just revisions to estimates. So I mentioned we estimate what the useful life is. We estimate what the salvage value is going to be. Well, those estimates change over time, right? We get more information about what values are, about how the asset's functioning, how long we think it will last, all of that. And we should amend what we're doing based on that new information to have it be most accurate. The key thing here is that we don't open up past financial statements and change them. So whatever we have recorded in past years that have been closed, that's done. So we look at where we stand and we make changes going forward. So if we've depreciated the asset for a couple of years and we decide it's going to last longer than we thought, we're going to take the new book value and spread that over the longer period of time. Excuse me. So now disposal of fixed assets. So assets that are no longer being used, we either discard them or sell them. So in this first example here, we have a fully depreciated asset that we get rid of, and we don't get anything in return for it. So we sign the title and push the truck in a ditch, as an example. In that case, we need to remove that asset from the balance sheet. So we credit accumulated depreciation, which has a normal debit or credit balance, and we credit equipment, which has a normal debit balance. So we do an entry to wipe those out. If you picture a T account, we're doing the opposite to zero it out. In this case, because it's fully depreciated, there was no salvage value, and we received nothing in return for it, there's no gain or loss. We just write it off. Next example here is it's not been fully depreciated, so maybe it's during the middle of the year, so we depreciate it up to that point of the year, and then we remove it. In this case, we have a loss because there is some book value, and we're just getting rid of the equipment without getting anything in return for it, so we recognize a loss on disposal of equipment. Now, of course, so that's how that's done. Now, I would point out that the loss on disposal of equipment, or we'll see in a minute here, there's a gain on disposal of equipment that could happen if we get something in return for it. That's going to be recognized below results from operations, because this is not the purpose of the company's business, isn't buying and selling fixed assets. So we separate that out so we can clearly see, are there continuing operations generating profit or generating losses without the impact of these kinds of transactions? So here's an example. If we sell it for, here we're receiving something in return for it. If we sell it for book value, then there's going to be no gain or loss. If we sell it for more than book value, we'll have a gain. If we sell it for less than book value, we'll have a loss. So that's how those kinds of transactions work, starting from simple to more complex. Next example I want to talk about is depletion. And depletion, we're going to look at the cost of a natural resource, and it's the entire cost of that natural resource. So it could be purchasing the land, developing the land. There could be costs that are incurred returning the land to its original state when we're done with it. We'll look at those costs and lump that all together and divide that by the amount of the material that we believe we're going to remove from the land. So the cubic volume of timber or the tons of some kind of mineral that we're going to extract, whatever the case is. And we come up with a rate, a depletion rate. And then each period, as we remove material from that land, we'll record that as either depletion expense or inventory if it's becoming a part of something else for manufacturing. And we'll have accumulated depletion that you can imagine is a contra account, has a credit balance, and it offsets the cost of the asset. The next category I want to talk about are intangible assets. So intangible assets that have a defined life are patents, which I mentioned earlier. That's a government granted license to be the exclusive provider of a particular product. My old company, Big Toys, had several patents that we spent money on with the federal government to get that kind of protection so that no competitor could copy those products, and we would effectively have a monopoly on something. So that lasts for 20 years. We could spread the cost over a shorter period of time if we think it's not really going to be of value for 20 years, but that's the maximum. Copyrights are similar, but it is literary, artistic, or musical compositions. That's the life of the creator plus 70 years, and then they expire. There are franchise and operating rights. If you see a Subway sandwich shop, somebody paid to have the right to operate a Subway sandwich shop in a certain geographical area. And they paid money to Subway Corporation to have that right for a certain period of time. That will amortize that over that period of time. And then there could be some development costs for technology. Think about the costs associated with creating a video game or that sort of thing. We can spread that over the time that we think that that's going to be sold. There are also intangible assets with an indefinite life. So there are trademarks, like I mentioned Coca-Cola earlier, the Apple logo, the Nike swoosh, all of those are trademarks that will last forever as long as the company demonstrates to the government that they're continuing to use them in commerce. So in my old company, we had several trademarks, and every 5 years I would need to pull together some evidence of examples of how we were using the trademark in advertisement or a label on packaging or something like that, and I would supply that to the government and they would renew the trademark. Goodwill is a little bit trickier. Goodwill only exists through an objective arm's length transaction where a business is sold. So if I buy somebody's business, I would look at the fair value of the physical assets that I'm purchasing. I would subtract any debt that I'm incurring or, kind of obligations that I'm now required to pay. And I would subtract those from the fair market value. That would be the fair market net value of the assets I'm purchasing, the net amount. So if I pay that amount for the business, then no goodwill is generated. If I pay a higher amount because of competitive reasons, what the person wants for their business, and maybe I'm competing with other people to buy the business, and so I pay more, that additional amount that I pay above the net value, fair market value of the assets is called goodwill. It's really the value associated with the reputation of the business, the loyalty of its customers, the quality of its staff, those kinds of things that aren't really represented in the financial statements. So this would be called goodwill. And both trademarks and goodwill, we would test it periodically at the end of each year to say, is it still have that value or have things changed? If things change, we need to write it down. Okay, fixed asset turnover is looking at how much each asset is generating in return in terms of sales. So are our assets being productively used to create revenue? So it's a simple ratio. Again, this would be used to kind of compare businesses in similar industries to see who is doing a better job of using their fixed assets. So lastly, exchanges of similar assets. So when we trade in old equipment on new equipment, like we trade in an old truck on a new truck, we're going to account for it a little bit differently. We could have a gain or loss on the trade-in relative to the trade-in value that we're given. So here's an example where we have the new equipment has a fair market value of $5,000 and they're giving us an $1,100 trade-in, so we have to pay cash of $3,900. So the old equipment at the time of trade-in had a cost of $4,000, accumulated appreciation of $3,200, so it had a book value at the date of exchange of $800. So we're getting a trade-in allowance of $1,100 for something that we're going to remove from our books at a net cost of $800. So we're going to have a $300 gain. So when we do the entry at the bottom, we're going to accomplish a couple of things. Number one, we're going to remove the old asset from the books. So we debit accumulated appreciation and credit equipment. And see how they put in parentheses old equipment? That can really help because you can see you've got two different entries for equipment there. So we remove the old asset from the books. We put the new asset on at its fair market value, $5,000. We record the cash that we pay, and then lastly, we record the gain, and then we check do debits equal credits. So it's kind of a multi-part transaction in a way, but it makes sense. So please work through the in-class practices for this chapter, compare it to the solutions you see on Moodle, and as always, email me if you have any questions. I'll talk with you next in the lecture for Chapter 9. Thank you.